The FedLife podcast is presented by Serving Those Who Serve, a fiduciary, fee-based financial planning firm serving federal government employees and retirees all over the country. This podcast is for informational purposes only and is not intended to be taken as financial advice. All listeners should consult their personal advisors before taking any action. The opinions expressed by our hosts are their own and do not reflect the views, policies, or position of Raymond James. Securities are offered through Raymond James Financial Services, Inc., member FINRA SIPC. Investment advisory services are offered through Raymond James Financial Services Advisors, Inc. Serving Those Who Serve is not a registered broker-dealer and is independent of Raymond James Financial Services, Inc. And now, here are your hosts. Dan Sipe serves as a branch manager for Raymond James Financial Services and Serving Those Who Serve. Ed Zerndorfer is our guest and federal benefits expert in the space.
Hello and welcome to this episode of the FedLife podcast. I am your host, Dan Sipe. Additionally, I'm the branch manager here at Serving Those Who Serve and Lee Sipe & Associates. I want to begin, as I always do, by saying thank you. Thank you for taking time to listen, but also thank you for your service to the government, to the country, to me, to everyone. You don't hear that enough, but you'll always hear it here. The other thing you always hear on this podcast is the guru, Ed Zerndorfer. He's back with us once again as part of our ongoing mission to reach, teach, and serve you. If you're a regular, you know, what we try and do is follow Ed's FedZone articles to give us one more way to reach and teach. So today we're diving into how the Secure 2.0 affects the Thrift Savings Plan. So Ed, why don't you walk us through what Secure 2.0 was and why we need to be concerned about it as feds?
Yes, Dan. Well, Secure Act 2.0 was passed back in December 2022. It was actually a follow-up to the Secure Act, which was passed in December 2019. Now, there was many provisions in coming out of Secure Act 2.0. We're going to be talking about the provisions that affect the TSP as well as other qualified retirement plans. Now, some of these provisions that were passed didn't take effect immediately. They were grandfathered. In fact, one of the provisions that has gotten very popular is just started in last week, in January 28, 2026, was the provision that allows federal employees and retirees who have traditional TSP accounts can convert their traditional TSP to the Roth TSP. That was not true until this provision, Secure Act 2.0, took effect as of January 1st, 2026. So it's now available. Gotcha. That's just one of them.
Okay, got it. Now, another big factor here for our feds has to do with changes to RMD age. So walk us through that one.
Yes, one of the provisions that came out of the Secure Act 2.0, again, was the fact that the required beginning date. Now, what is one's required beginning date? If one owns a traditional IRA, if one has participated in a qualified retirement plan, such as a 401k plan, such as a 403b plan, 457 plan, a SEP IRA, simple IRA, or the Thrift Savings Plan, when you reach a certain age, you must withdraw a portion of your your qualified retirement plan or TSP or traditional IRA. It's called required minimum distribution. I say when you reach a certain age, and that age for years until the passage of Secure Act, the Secure Act back in December 2019 was 70 and a half. The rule was that you must withdraw, if you are participating in a qualified retirement plan, traditional IRA, your RMD, your first RMD is due no later than April 1st following the year you turn 70 and a half. It's called the required beginning date, and that applied to the TSP. Now, in order to understand as far as the TSP is concerned, I want to emphasize the fact that there are exceptions when it comes to taking your first RMD, and that first RMD is, as I said, was following the year that you become age 70 and a half. But you have to be retired from the company or the federal government if that's offering a 401k plan in order to be required to take RMD. If you're still working at 70 and a half at your required beginning date at that time. You're not required to take an RMD at that time. Your first RMD is due no later than April 1st, following the year turn 70 and a half. One of the provisions coming out of the Secure Act was that Congress raised that RBD, requirement beginning date, to age 72. You had to take your first RMD no later than April 1st, following the year turn 72. That applied, though, to individuals who were born after June 30th, 1949. And again, it applied to those individuals. Then Secure Act 2.0 came along. Congress raised it again, and the RBD age was raised to age 73. How so? If you were born after December 31st, 1950, and before January 1st, 1959, your required beginning date was April 1st, following year you turn 73. 73. For anybody born after December 31st, 1958, Secure Act 2.0 said your required beginning date is April 1st, following the year you turn 75. And that's what it all is. And I just want to mention, it is amazing I run into. I ran into an individual who lives in my community who's 64 years old. He's retired from federal service, and he's worried about taking his RMD. He's worried about the tax consequences of taking his RMD. And he said, well, I have about 6 years to go. What are you talking about? You're 64 years old. You were born after December 31st, 1958. Haven't you heard that your RMD, since you were born after December 31st, 1958, is age 75? Oh, I didn't know that. So there are a number of individuals out there who are not aware, both in federal government, with TSP, work in private industry, even IRA owners, Dan.
Yeah, I believe you.
This. So this is very important because, as we're going to find out, this RMD can really cause some tax consequences.
Sure.
In terms of when you have to start taking the money out.
And Ed, let's touch again briefly on our feds that are still working, bless their hearts. If they reach that RMD age, be it 73 or 75, they have slightly different options where TSP is concerned if they're still working, correct?
I don't know if there's somebody. Well, again, if you've reached your RBD, but you're still working for the federal government, I want to emphasize, Dan, you're not required to take an RMD, as we'll find out here in a moment, from the traditional TSP. But suppose you are a Fed now, still working, you're 74 years old, I know somebody, and you have a traditional IRA. You still have to take your RMD from the traditional IRA. Maybe you worked in private industry as a Fed. You came to the federal government when you were working in private industry. You had a 401k plan, and you participated in that plan. You left that employer. You couldn't put any more money into the 401k plan, but you left it there. Now you came to the federal government, working, putting money into the TSP. You've reached your RBD, required beginning date. You got to take money from that 401k plan? Yes. One possible solution to that, Dan. One possible solution. The TSP allows TSP participants who have traditional IRAs, who have 401k plans, 403b plans, SEP IRAs. They're allowed to do a direct rollover of the IRA and the 401k plans directly into your traditional TSP. And if you do that before you reach your RBD age, this way you don't have to worry about it because everything's inside the TSP. It's something to it. I'm not giving advice here to do it. There's some pros and cons of keeping common accounts separate. But again, this is one possible solution because I know there's a lot of heartaches when it comes to RMD. One heartache is if you have multiple retirement accounts, you got traditional IRAs, each plan has its own RMD. It sometimes can cause some real problems among people where the misunderstanding, because there are penalties if you don't take the RMD.
Well, perfect segue, Ed. With regards to Secure 2.0, they've made some changes in what those penalties look like. So tell us about those.
Well, let's talk about the penalty before they changed it, Dan.
Right.
What was the penalty before they changed it? In other words, the penalty is
Half.
if one is subject to RMD, and let's say they didn't take it. They didn't take the RMD. Here they have a traditional IRA, and they were supposed to take an RMD of $25,000. How was calculated for a given year. They were subject to RMD. They did, and that RMD amount for that year was $25,000. They didn't take it. What's the penalty? What's 50% of $25,000, Dan?
$12,500.
$12,500. That's a lot of money.
Mm-hmm.
And the penalty is not just a one-time penalty, because if you don't take it out, you don't do it. It's $12,500 per year. That's a huge penalty.
Absolutely.
Well, come Secure Act 2.0, they lowered the penalty down to 25%. 25%. And actually, it can be lowered. It can be lowered to 10% if an individual has an excuse that meets the IRS definition of why they missed it. Okay, it's actually contained in Section 497E of the Internal Revenue Code. But Dan, I just want to mention something. I had one client that did his taxes, fortunately passed away. He missed 10 years worth of RMDs. That's how I got him as a client. And when the IRS, when you file your taxes, that's when you file the taxes, you have to report the fact that he missed the RMD and what the penalty is. Well, there's a section on this form that says, well, what was the reason? Was there any reason that he missed the RMD? So I wrote up the reason for each year. He had some medical problems. His wife had some medical problems. He just flew right by him. And the IRS accepted it. No penalty. So if someone's out there has this RMD and they know they missed an RMD, let's say from last year, someone gave her that, don't ignore it. Tell your accountant, and the accountant can write up a reason. And the IRS, they do have a heart and soul. I just want to say that. They do have a heart and soul. So they would likely forget the penalty.
Gotcha. That's still a big drop down from the 50% penalty. So that's a significant improvement. Now, let's talk about Roth TSP accounts and RMDs. There was a big change as of January 2024, correct? So what
yes,
happened
Dan,
there?
this is a big one. This is a big one. Let me go back before the passage of Secure Act 2.0 in terms of the TSP RMD, just to repeat that if you are a retired Fed with a TSP account, and during your years as working as a Fed, you contributed both to the traditional TSP and to the Roth TSP. You had two separate accounts. Before January 1st, 2024, before they changed the law, when the TSP calculated your RMD, you've reached required beginning date. Again, what is happening here is the TSP looks at your account balance as of in a given year. Go back to December 31st of the previous year, and what was your TSP account balance? When I say your TSP account balance, you add up the balance as of December 31st of the traditional TSP and the Roth TSP. Combine them. Divided by a life expectancy factor, which is in the IRS table, it's the uniform table, and that's going to be your RMD for the year. Now, I always felt bothered about that. What I say that because when you have the Roth TSP, one of your options, what you could do with the Roth TSP is, after you retire, is to do a direct rollover to a Roth IRA. They're similar. Money going into the Roth TSP, contributions are with after-tax salary. Contributions going into a Roth IRA also are with after-tax money. Earnings grow tax-free. Because I say that because when money is withdrawn from the Roth TSP or the Roth IRA in a qualified distribution, it's called, after age 59 and a half, there's no tax consequences. But most important, the Roth IRA has never been subject to RMD. That's another beauty of the Roth IRA. There is no RMD. So why is the Roth TSP going to be subject to RMD? It didn't directly. It bothered me. So I would advise clients, well, I just don't like this idea that they're including the Roth TSP. It's driving up the value of your account, which means your
Sure.
RMD is going to be higher. So the client would say to me, what can I do? I said, very simple. Before the year you reach your required beginning date, do a direct rollover of your Roth TSP account to a Roth IRA. This way, you'll get it out of your Roth TSP account. It'll be the same thing. You'll have a tax. You'll have an account that's tax free when you take the money out, and you don't have to take it out. Welcome to Secure Act 2.0. The TSP says we are not going to include the Roth TSP account balance in the calculation of the RMD. That is a big thing. So you still can do this. You still can roll over your Roth TSP to Roth IRA. There's some pros and cons, which I'm not going to get into now in terms of going to the Roth IRA. I did write a column in the Fed Zone. If anybody was interested, a comparison between Roth TSP and Roth IRA, which is not better, which is more appropriate, all the advantages and disadvantages. But the point is, at least you don't have to worry about when you're putting all that money into the Roth TSP that your RMD therefore is going to be higher. That's the point. That was the point of that.
No, agree. That's a big shift. And then that Roth TSP balance just keeps growing tax-free, and it's not hurting you in any way to do that. Now, let's shift to contribution limits, because Secure Act 2.0 made a super catch-up, right? So walk us through that.
Yes, with the Secure Act 2.0, another provision is that starting, in this case, January 1st, 2025, that was a little over a year ago, that anybody who is who's between the ages of 60 and 63 in any given year can make a super catch-up into the TSP. What's a super catch-up? Well, let's take this year. Again, we're talking about a catch-up contribution. Let's review what the contributions limits are for 2026. Anybody, no matter what their age is, can contribute $24,500 in what's called elective deferrals. That's the limit this year. Those elective deferrals include contributions to the traditional TSP, to the Roth TSP, or both. That's elective deferrals. Anybody, full-time employees, part-time employees, they have to be permanent employees, of any age. Now, if you're going to be over age 49 as of December 31st, 2026, translated, that means if you were born before January 1st, 1977, that'll make you at least 50 as of December 31st, 2026. Then, if you are between the ages of 50 and 59, or you're over age 63, your catch-up contribution is $8,000. That's an increase from last year, $8,000. Okay, so that's a total of $32,500. If an employee is going to be age 60, 61, 62, or 63 during 2026, if you were born between January 1st, 1966 and December 31st, 1969, you have a super catch-up of $11,250. That's $8,000 plus $3,250, which means your total contribution of $24,500 plus $11,250 is $35,750. Now, again, it's only for people 60, 61, 62, 63.
Yeah,
amazing.
Which means excluding Dan. I'd like to point that out, and excluding Ed for that matter.
Oh, me too.
We're not bitter about it or anything.
I do respect my younger people, but I know how you feel.
Yep. Okay, so that's not the only thing, Ed. There's a brand new provision that took effect in January 1st of 2026 regarding catch-up contributions and your salary level. So this one's important. What's that rule?
Oh, this is an important one. This took effect, as you say, Dan, on January 1st, 2026. That if you're eligible to do catch-up contributions, that is, you're over age 49. And when I say catch-up contribution, I'm including both the regular and the super. You're eligible. You're over 49. If it turns out that during 2025, your wages, we'll talk about what wages we're talking about here in a moment, exceeded a certain amount, namely $150,000, then once you reach the point where you have put in the full $24,500, and now you're eligible to do catch-up contributions, you're over 50, your contributions have to go to the Roth TSP. You can't put it into the traditional TSP. They have to go to the Roth TSP. Now, it sounds easy on paper, but there's some complications here. And I got to tell you, I read the TSP a publication about this, and they were a little fuzzy in terms of how they explain it. Okay.
I remember that.
Number one, it only applies, though, to TSP participants who were working in federal service last year in 2025. Let's suppose you came into federal service after December 31st, 2025. You're over age 50. You're going to be 50 or older this year. And let's face it, there are employees coming into the government in their 50s for a variety of reasons. And they say, oh, this great opportunity. I think I'll put in the maximum possible, 24,500 plus 8,000 or 11,250, whatever your age is. And last year, their wages, they work in private industry, was over 150,000. It doesn't apply to them because they were not in federal service. Here's the other question. When I say wages, what wages are we talking about here? It's called Social Security wages. Social Security wages. If you worked in federal service last year, you got paid, you earned a certain salary, and by now you should have received your 2025 W-2 statement. Your payroll office gave you. Now, there are a lot of boxes on a W-2. Most people are interested in one thing. Box one, my taxable wages. Okay? And then you look at the amount of federal income tax taken out, that's another box, and state income taxes and so on. But they want to look at those taxable wages because that's what they're going to need to do their tax return. There's another box there. Two other boxes regarding wages. Box 3, Dan, says Social Security wages. Box 5 is Medicare wages. Taxable wages, Social Security wages, and Medicare wages are not all going to be all the same. So, Secure Act 2.0 said is that during a given year, if one Social Security wages, as shown in Box 3 of their W-2 statement, is over a certain amount, when Secure Act was passed, it was supposed to have started in 2000. This provision was supposed to start in 2024. It was delayed. They delayed it to IRS until 2025. They said it'll be 150,000. It'll be 145,000. Well, payroll offices around the country are screaming to IRS, we just don't have the resources yet to implement it. So IRS delayed it to January 21st, 2026. So now the index wages are 150,000. I see, and it goes up every year. So you have to look at what your index wages were, which your Social Security wages factor in 2020, and you can see on your W-2 statement that you got for 2025. You got your recent idea what that is. But again, you must have worked for the federal government for this. If you didn't work for the federal government last year, you were in private industry, you could have earned your Social Security wages could have been the maximum, which was I think 176,100. That's the maximum. you can put in when it comes to the catch-up contributions, you can continue to put into the traditional TSP.
Gotcha. But one thing I want to make sure folks understand, it's an automatic thing though. If you did hit that over 150 Social Security wages the previous year, that's not something the feds are going to have to remember to do. It's going to happen automatically for them, correct?
That's correct, Dan, but I got a question.
Okay.
I question that. Okay. Here, let's say we have an employee who's over 50. They know their Social Security wages, and they worked for the federal government in 2025. Their Social Security wages were over $150,000 last year. So they decide that they're gonna start contributing to the TSP from the first pay date in January 2026. They make the election, through their electronic benefits sign off, and they say they'll put in, let's say, $1,500 a pay period into the traditional TSP, and then I'm all set now. So who's processing this? Their payroll office. Does the payroll office going to be checking what their Social Security wages were in 2025? Is it going to be their responsibility? The employee doesn't have to is not going to be obligated to change what their TSP the contributions are going to which TSP account once they reach that $24,500. Whose responsibility is going to be to change it over to let's say when they reach that $24,500 to the Roth TSP? I'd like to know how it's going to work.
On paper, it sounds like that's payroll's job.
And they can be, and they'll do that?
We'll see.
It's going to be very interesting. So
no, I got you.
I was thinking about that. But
as always, the devil's in the details.
Yeah, see how it's going to work. I should ask them. I mean, I know somebody still working federal service, and to see if they're making catch-up contributions to see what's going to happen when they reach that level. Will they automatically switch over, if they're making traditional TSP contributions, to the Roth TSP once they reach that $24,500 level?
Sure. Well, sir, you did it again. You took some really chewy and complicated tax things and got them to a place where our feds can understand them. I don't know how you keep it all straight, but I'm glad you do, and I'm glad you do it with us. So thank you for that, Ed.
My pleasure. Thank you.
Well, folks, that's a wrap. Hopefully we've given you what you need to know to be prepared for this tax year relative to Secure 2.0. We are Serving Those Who Serve. Be sure to subscribe to this podcast on YouTube, and please remember to share it with your friends and even a few strangers. Don't forget those live webinars we do every single week. Just go to the SWS website, fcwserve.com. You'll see the button, click it, and it brings up the whole menu. Yes, the guru will come to you as we reach, teach, and serve you where you are. Sign up for one, sign up for all, share it with friends. I guarantee they will thank you. Be sure to read Ed every single week in the Fed Zone. That's fed-zone.com. So for Ed, the crew at Serving Those Who Serve, and me, Dan Sipe, I'm going to sign off as I always do by saying good luck, Godspeed, and above all, remember, it's your Fed life. So make it a great one because you deserve it. Stay well, everybody. We are out.